Hello everyone, a very good morning. So this is the second mini marathon in our series for the CAIIB November-December 2025, and today we'll be covering the module B, the most important questions of our module B we are going to cover today in one shot. So quickly everyone join the session, share the video with your other fellow aspirants as well, and we'll be following the same thing. You'll get question on your screen. I'll give you 10 to 15 seconds to comment down the correct answers, and then we will discuss the theory related to it. Good morning, a very good morning. I'm good, thank you. So let us start with the first question from our module B. Okay. Under the section 13 subsection 2 of our Prevention of Money Laundering Act as amended by the 2012 Act, which of the following actions can the director legally take against the reporting entity for non-compliance with the obligations under the Chapter 4? So the Prevention of Money Laundering Act, which is a very important act from our Module B, it this talks about how can we prevent the concealment, the possession, acquisition, use of untainted, the tainted property, right? How can we prevent money laundering? For this, a very important role has been given to the banks, the financial institutions, because most of these transactions they happen through the banking machinery. So the chapter 12, which was included in the act in the 2012 definition, it has enlarged the definition of money laundering, as well as it has given the responsibility to the financial institution. They need to report certain transactions outside of India, that the money is sent beyond a certain limit. Like this, they need to send the report. They also need to maintain the records. If they contravene, then there are penalties and offenses. All right, so the director, in the course of any inquiry, if it finds, yes, if the director finds that the reporting entity or the designated director on the board or any of the employees has failed to comply with the obligation, then they can issue a warning, direct the reporting entity to comply with the instruction, direct them to send reports at intervals as may be required, and they can also levy a fine which shall not be less than 10,000 rupees but can be extended to 1 lakh rupee for each failure. So the correct answer is B. Right. Other than this, the offense of money laundering definition has been increased. The person who is actually involved in the process, or the person who is indirectly involved in the activity connected with the proceeds of crime, concealment, possession, acquisition, use, and projecting, claiming some tainted property as untainted property, they will be guilty of the punishment, the offense of money laundering. Okay, here's a scenario that is given to you. A financial intermediary receives 4 lakh rupees cash deposits over 25 days from a single client, each 9 days apart, into different branches but linked by the same mobile number. What is the compliance implication under rule 3B? So go through this scenario and then determine whether the last transaction record need to be maintained, or the record is required unless the cash deposit exceed 10 lakh individually, the record will not be required. All three must be collectively treated as integrally corrected and recorded. Reporting is required only if the deposits are in foreign currency. So these are the obligation of the banking company, the records to be maintained. So all cash transaction of value more than 10 lakh rupees or its equivalent in foreign currency, this is there. Then all transactions involving receipts by non-profit organization more than 10 lakh rupees also need to be maintained. Suspicious transaction counterfeit or forged currency note, collection all of the cross-border wire transaction more than 5 lakh rupees. Similarly, immovable property. But here the scenario says that one single transaction was less than 10 lakh rupees, but within 1 month, within 30 days, all these transactions are integrally corrected. Yes. Why? Because they are linked to the same mobile number. So doesn't matter even though they were of less than 10 lakh individually, they were 9 days apart, also from different branches. Still, the deposits were within 1 month time period. So, yes, all three must be treated collectively as integrally connected and the record needs to be maintained. So, the correct answer is C. All right. So, remember this provision under section 3 of the Act. It is very important that you remember all of these clauses A, B, BA, C, D, E, and F, which talks about the different types of transactions. Also, the procedure for furnishing the information, like when we are talking about the cash transaction, individual cash transaction, counterfeit currency note, within how many days the record has to be furnished to the designated director within 15 days of the succeeding month. Similarly, when some suspicious transaction is involved, suspicious transaction, then within the next 7 working days, the transaction has to be reported. Like this, the procedure also is important. Okay. The rule 3 requires reporting entities to maintain records of which of the following high value transactions involving instruments other than cash. Now, other than cash is given under the D. Okay. So, which of the following statements are correct? Purchase of immovable property registered and valued at 60 lakh rupees. Cross-border wire transaction of India of 6,000 euros. Subscription of rupees 15 lakh in the non-convertible debentures. 5 lakh transferred from a security account linked to NBFC. So, apart from cash transaction, deposits that are made by the way of check, traveler's check, transfer from one account to another, any other mode, payment order, cashier's order, demand draft through the automated clearing houses, subscription to the debt instrument, purchase and negotiation of bills, foreign exchange contracts. These are also the records that need to be maintained. But out of these four, one is not the typical type of contract or transaction. So what should be the correct answer? 1, 2, and 3, 2, 3, and 4, 1 and 3 only, or 1, 2, 3, and 4 only. Other than cash, high value transaction, purchase of immovable property valued more than 50 lakh rupees has to be maintained. So here statement 1 will be correct. Cross border wire transactions more than 5 lakh rupees or its equivalent in the foreign currency. So this is equivalent in the foreign currency. Subscription to 15 lakh in the non convertible debentures also has to be maintained, but 5 lakh transferred from a security account linked to an NBFC, no such requirement is there. All right, so the correct answer will be A, not B, A. A is true, right? It is more than 50 lakh rupees, so the record has to be maintained. So A will be correct, 1 will be correct. All right. What will be involved in the records? The nature of the transaction, amount of the transaction, date on which it was conducted, parties to the transaction, right? And the time period is also important. Okay. Next, we have questions from our Negotiable Instrument Act. Which of the following are true in relation to the interim compensation under Section 143 A of our Negotiable Instruments Act? So, the Negotiable Instruments Act of 1881, there are certain sections that you need to remember. 143A that talks about interim compensation, section 148 which talks about the appeal, 148 which talks about the appeal, section 138 which is related to the conviction of the dishonor of check, right? Other than that, how protection is given to the collecting bank, the paying bank holder in due course, these topics are important. Now answer this question. Interim compensation must be paid within 90 days from the framing of charge, can be recovered as a fine under section 421 of the CRPC. If the drawer is acquitted, the complainant must refund. Acquitted means found not guilty, applies retrospectively to all pending cases. So the Negotiable Instrument Act, Section 143A, talks about the dishonor of the negotiable instrument. So when there's a dishonor, it is a criminal offense, but the drawer of the check has the right to make an appeal before a competent court. Right? They can say that this dishonor is wrongfully imposed on me. For that, their side will be heard by the court, but first they need to pay some interim compensation. What is this interim compensation? It is 20% of the check amount to be paid to the complainant, where the drawer pleads not guilty, right? It has to be paid within a prescribed time period of 60 days, or it can be extended to more 30 days if allowed by the competent court, right? So first statement is correct. It is a fine. Yes, it will be recovered as a fine. If the drawer is acquitted, if the drawer is found not guilty after the proceedings of the court, the complainant, the bank will have to return this interim compensation back to our drawer, right? That too within 60 days plus 30 days, maximum 90 days. All right. But the fourth statement, it applies retrospectively. No, it applies prospectively. All those check dishonor cases after 1881, when the act came into force, only those cases, the section 143A will be applicable. All right, so it applies prospectively, not retrospectively. So the correct answer is A. Everyone who's present here, please like the video and also share it with others. And answer the questions. Try to answer all of these questions. Okay, moving on. As per the newly inserted section 148 of the Negotiable Instrument Act, what is the minimum quantum of deposit the appellate tribunal may require from the appellant during the pendency of an appeal against section against the conviction under section 138. So when the competent court gives a decision under section 143A, or the case is pending and the drawer or the complainant wants to take it to the appellate court, they can do it, but the section 148 says that you need to deposit a certain amount. So what is the minimum? 10% of the check amount, 50% of the check amount or interim compensation, full amount of the check dishonored and interest at bank rate, 20% of the total fine or compensation awarded. Yes, absolutely. The correct answer is D. So, appellate, when the appeal is filed by the drawer against the conviction made under section 138, the appellate court will order the appellant to deposit 20% of the fine or the total compensation as awarded by the trial court, not the check amount. And this 20% will be in addition to any interim compensation. In addition, right? It has to be deposited within 60 days or extended 30 days, total 90 days. If, let's say, the drawer is acquitted, again it will have to be returned back to the drawer, right? penalty will also be imposed, some interest rate at the bank rate will also be imposed. That is a separate thing. Okay, so interim compensation can also be 20% of the check, and the deposit in case of appeal will be 20% of the award as decided by the trial court, in addition to the interim compensation. Okay. Choose the correct statement about the instances of material alteration in a check. Alteration in the name of instrument can hasten or delay the time of payment. Alteration of the amount is the most common form of fraudulent alteration. Alteration of the name of payee does not count as material alteration. Alteration of an order check to a bearer check is a form of material alteration. You need to select the incorrect statement. All right. You need to select the incorrect statement. So, what is material alteration? Material alteration means that any change with substantially alters the meaning of the negotiable instrument. The negotiable instrument speaks a complete different language in the legal terms what it actually intended to speak, right? So alteration in the date of the instrument, alteration in the amount, alteration of an order check to a bearer check, and yes, alteration of the name of the payee, the beneficiary, is also known as a material alteration. All right, so if there is a material alteration and the bank still pays the negotiable instrument, the bank will not be given protection. But if the material alteration is not discernible, it is not visible to the naked eye, and then the bank makes the payment in due course, the bank will be given protection under section 89. All right, where the negotiable instrument is materially altered but does not appear to have been altered, and the payment is made in due course by the bank, they are discharged from all liability. Right? They cannot be questioned that the instrument had been altered. This is another important section, section 89. Okay. Now, other important topics are also there in your negotiable instrument. We'll be covering it when we have other marathon sessions. All right, don't worry about it. Next, we have questions from the FEMA. Identify the true statements about the current account transaction. It includes payments due as interest on loans. It involves changes in the asset or liabilities outside India. It includes remittances for living expenses of family members residing abroad. It includes expenses in connection with foreign travel, education, medical care of the family members. So there are two types of transactions: current account transaction and capital account transaction in our balance of payment. In the current account transaction, there is no change in the asset or liability situation of a person resident in India for their transaction outside India, or a person resident outside India for the transaction in India. That is a current account transaction. And if any transaction changes the asset and liability situation, then it is a capital account transaction. All right, then it is a capital account transaction. So, which of these come under current account? You need to identify the statements. What will be the correct answer? Statement 2, A, C, and D. Yes, correct. Absolutely correct. A, C, and D. If it changes the asset or liabilities outside India, then it will not be a current account transaction. It is a capital account transaction. All right. So payments due respect to the foreign trade, import and export. payments as interest on the loans, and receiving income from investment, remittances, one-way transfer to parents, friends, anyone, expenses in connection with the foreign travel. These are what? These are current account transaction. Capital account transaction which would change the asset liability situation, like purchasing a property, investing in the new security, giving or taking a loan. Those are capital account transaction. Okay. Select the correct statements about the rights of persons resident outside India. Now, the classification of individuals under the person resident in India and a non-resident is given in our FEMA Act. It is important for the taxation as well. So, the person resident outside India cannot hold foreign currency. Person resident outside India can invest in foreign securities. Person resident outside India can own immovable property outside India. Person resident outside India must repatriate any assets to India. Okay, so a person residing in India for more than 182 days in the preceding financial year is a person resident in India, but it will not include a person who has left India for taking up any employment in the foreign country, or carrying out any business in the foreign country, or let's say they have gone for a medical treatment and we have no idea when they're going to return. Those will be classified as person resident outside India. And if there is a citizen of any other country, but they come to India for taking up employment, carrying out a business, or they are living here for more than 182 days, 182 days in the preceding financial year, they will become a resident in India. Now, when we are talking about person, person will also mean individual, branch, office of a company controlled by the person resident outside India. All right. So here we are talking about the rights of the person resident outside here. Is there any restriction on them holding property or currency? Can they not hold foreign currency, or they cannot buy property from outside? No. You're saying 1, 2, and 4. Person resident outside India cannot hold foreign currency. Why? They can hold foreign currency, they are allowed to hold foreign currency. If they are sending any foreign currency beyond a limited threshold without the authorized person, without their approval, that would be a contravention. Otherwise, there's no restriction on them holding. Person resident in India cannot hold foreign currency without the permission of the authorized person. All right, so this statement is incorrect. Second is correct. Person resident outside India can invest in foreign currency. They are living in that country. They can obviously invest in the foreign currency. Okay, no restriction on that. A person resident in India, they have to make an investment beyond the threshold through the authorized person. Okay, so second statement is true. Third, the person resident outside India can own immovable property outside India. Yes. If they want to hold immovable property inside India, then they will have to take permission. All right. So this is also correct. Person resident outside India must repatriate any assets. Now, this is a very tricky concept. Repatriate in India means that the selling of foreign exchange to an authorized person in India in exchange for rupees. I am a resident of India. I hold some foreign securities, or I hold a foreign property. I own a property situated in USA. If I am selling off that property to some other person, I cannot keep the proceeds deposited in an account in USA itself. No, I will have to bring it back to India. So any asset, no. But if the transaction is by a person resident in India, then it has to be repatriated. So this statement is also incorrect. The correct answer will be D, 2 and 3 only. All right, 2 and 3 only. Restrictions are there if the person is receiving any foreign remittance beyond the threshold without an authorized person, or they're investing outside without the authorized person, and repatriation involves when the foreign asset is sold by the person resident. All right. Okay, next. Which of the following is a condition that an authorization to be issued under the Payment and Settlement System Act must state? So, when any entity, when any person wants to commence the operation of a payment system provider, they first need to make an application to RBI. They need to obtain RBI's approval and license. If they want to make any change in a substantial change, then also they need to get RBI's prior approval. All right. So the designated authority, RBI, for the regulation and supervision of the payment system. When the entity applies for their authorization, RBI will grant authorization after conducting its scrutiny. What needs to be given in the authorization certificate? The name of the payment system operator, the date on which the authorization takes place, the address of the payment system operator, or the duration of the authorization. What will be the correct answer? Under subsection 1. Correct. The date on which the authorization takes place. So, when an application is made to RBI, the RBI will check what is the need of the proposed payment system, the technical standards, the terms and conditions, the manner in which the transfer of funds will be done, netting or through gross settlement, the procedure for the effecting of payment obligation, interest of the consumers, any such factors. When the authorization is issued by RBI, it will state the date on which it takes place, the condition subject to which the authorization shall be in force, the payment of fees required, furnish any security, and it will continue till it is revoked. The revocation or cancellation can also be done by RBI only. Address, name, or duration is not to be given. Okay. What happens to a settlement effected under the procedure initiated in the rules for the operation of payment system? What is the nature of a settlement of transaction? It is final and irrevocable. It can be revoked at any time. It requires further approval from the court, or it is subject to review by the participants. So, what is the nature of a completed transaction? A, B, C, or D? Very simple question. So, in NEFT, RTGS, IMPS, all the types of transactions, they are final and irrevocable. Correct. Right? It is final and irrevocable. Okay. RBI is a designated authority. RBI has the power for regulation and supervision. Any changes in the payment system or any charges that may be levied will be regulated by RBI. Prior approval of RBI is required. Payment system provider cannot charge anything from the customers. RBI has the power to access the information, conduct the inspection. They can authorize an officer in writing to enter the premises, check the documents, call upon any employee to provide any information. RBI also has the power to issue directions that would be binding on the system provider. All right. So these are the powers of RBI. Okay. Which statements are true about the features of a simple mortgage? Now we'll be discussing some questions on the types of mortgages given in our Transfer of Property Act. The mortgagee has no power to sell the property without intervention of the court. The mortgagee is entitled to payments out of the rent and produce of the mortgaged property. Mortgagee is not put in possession of the property. Registration is mandatory if the principal amount secured is rupees 100 and above. So mortgage is what? It is a transfer of security interest in the immovable property, specific immovable property, for securing the payment of money, right? So the borrower is known as the mortgager, the lender or our bank is known as the mortgagee, the principal plus interest secured is known as the mortgage money, and the contract is known as the mortgage deed. Now, when we are talking about the simple mortgage, without delivering possession of the mortgage property, the mortgager binds themselves personally to pay the mortgage money. And they agree that in the event of default, in the event of failing to pay, the mortgagee will have the right to cause the mortgage property to be sold by a decree of the court. All right. So, yes, the correct answer is D, 1, 3, and 4. The mortgagee is not entitled to the rent and produce. You tell me in which type of mortgage the mortgagee will have the right to claim the rent and profits as well. The rent and profits. In which type of mortgage is this allowed? Which type of mortgage is it? Where the rent and profit, yes, it is the usufructuary mortgage. Great. All right. Next question. Under a mortgage by the way of conditional sale, which of the following statements are true? The sale becomes void on repayment of the mortgage money. The mortgagee can look to other properties of the mortgager for repayment. The sale shall become absolute upon non-payment and a court decree in favor of the mortgage. The bankers prefer this type of mortgage due to its simplicity. So what happens in the conditional sale? There is a sale. The mortgager delivers the property, right, to the mortgagee, right? They deliver the property in the legal sense. In the legal sense. And there's a condition involved. When the default happens, the sale shall become absolute. When the payment is done, the sale will become void, and in this case, the mortgagee will have to return the property back to the mortgager. So, this type of conditional sale is known as ostensible. It is a ostensible sale where the mortgager ostensibly sells the mortgage property. On default, it will become absolute. On the payment being made, it will become void. On such payment being made, the buyer will transfer the property to the seller. Okay? And here, the mortgagee cannot look for other property of the mortgager, right? So if the mortgage property does not prove sufficient to recover the mortgage money, the lender cannot look to other types or other property that has been kept as mortgage or the other property belonging to the mortgager. Another thing, there is no personal covenant to repay the debt. Personal covenant to repay the debt means that if there is any shortfall, then the bank can recover it from the customer. That is also not there. It is there in the simple mortgage. But 4, 1, 2, and 3 is not correct. Bankers that no, it is correct, right? Huh. The correct answer will be 1, 3, and 4. The correct answer will be, wait, not 4, 1 and 3, A, right? Bankers do not prefer this type of mortgage. Why? Because there is no personal covenant to repay the money, and the mortgaged property, again, the mortgager cannot, the mortgagee cannot look for other properties of the mortgager. Bankers, they do not prefer this type of mortgage, and the mortgagee also cannot look to other properties of the mortgager. The other two statements, 1 and 3, are correct. All right, 1 and 3 only are correct. 1 and 3. Next, which statements are true about the essential features of an anomalous mortgage? It must be a mortgage as defined by the Section 58 of the TP Act. It is positively defined as one of the listed types of mortgages. It is usually a combination of two mortgages. It does not involve any transfer of interest in the property. So, what is an anomalous mortgage? Anomalous mortgage means a type of mortgage which is not any other type. Not. When the term not comes, it means it is negatively defined. It does not have its own identity. It will be a combination of the other types of defined mortgages under the Transfer of Property Act. It can be a combination of a simple and usufructuary mortgage, or a usufructuary mortgage accompanied by the conditional sale. What does the usufructuary mortgage say? That we can recover the rent and profit to be used as EMI or interest payment. Conditional mortgage would, a combination of it would mean, in the case of default, there will be a sale that would become absolute. All right, this will be a combination. So the correct answer is B, yes, 1 and 3. It is, it should be a mortgage defined in the section 58, and it is a combination of the other two mortgages. It is negatively defined, and it does involve a interest, a transfer of interest in the specific immovable property. Okay, so the correct answer is B. According to the section 47 of the Registration Act 1904, from when does a registered document operate? When a loan is extended by the bank, we say that they need to get it registered to be known as a secured creditor. So, from when this registered document will have its identity? From the date of its registration, from the date it is presented in the court, from the date of its acquisition, or from the date of its notarization. What will be the correct answer? You are saying A, from the date of its registration. See, registration date is when it is officially recorded by the registrar's office. The date when it is officially registered, it is recorded. But the execution date is when it is officially signed by all the parties. And execution date is the date when it becomes legally valid. Do not get confused here. Right? The correct answer is C, from the time of its execution. If I file the registration to the registrar will send a notice to the creditor whether this is a correct registration or not, a correct charge or not, whether the information given in the form is correct or not. And when I get the signature of the other parties also, then only it will become legally binding. All right. So the date of execution is the date on which all the parties have signed it, making it legally binding and enforceable, even if it is registered on a later date. All right. It will start execution when it is signed by the parties. The registration date is when it is officially recorded at the registrar's office. So do not get confused. When it is officially recorded at the registrar's office, it is the registration date. When it is signed by all the parties, it will become legally valid and binding. Then it is the date of execution. And it becomes operated from the date of execution. All right. Which statement are true about the rules of appropriation under the Indian Contract Act of 1872? A creditor can apply any payment received to any debt. A payment must be applied to a specific debt indicated by the debtor. The debtor must always specify the debt for which the payment is being made. The payment can be applied to any debt if no specific debt is indicated by the debtor. So, in the appropriation, when several distinct debts are owned, this person A has taken several distinct debt from the same person, from the same creditor, let's say of 20,000 rupees, 50,000 rupees, 60,000 rupees, and they make a payment of, let's say, 10,000 rupees. So appropriation would mean which debt will be paid off using this 10,000 rupees. That is the meaning of appropriation. So the debtor can also give an express or implied intimation how it has to be applied. If the debtor does not, then the creditor can use its own discretion. And if neither the debtor nor the creditor appropriates, then the Clayton's rule will be used. The Clayton case, that is, the debt first in time will be paid off. All right. So the correct answer will be D, 2 and 4. When a debtor specifies the specific debt on which the payment must be applied, it has to be followed by the creditor. Yes, correct. 2 and 4. And the payment can be applied to any debt if no specific debt is indicated by the debtor. So the creditor can use the payment to apply it to any debt, whether time barred or not, whatever is the interest rate created first or not, they will have the discretion. All right. What does the section 132 of the Transfer of Property Act 1882 state about the rights of an assignee? So, assigner and assignee. A, B, and C are three people, right? B owes a debt to A also owes a debt to B also owes a debt to C. So what will B say? B can say that you directly pay this debt to C. This is what? This is assignment. I am assigning my duty, burden, any detriment to another party. This will be known as the assignee. All right. So what are the rights? The assignee has rights greater than those of the assigner. The assignee has the right equal to those of the assigner. Assignee has the right less than those of the assigner. The assignee has absolute rights over the assigned debt. What are the rights of the assignee? So when any right, any liability is assigned to them, they step in the shoes of the original person, the assigner. They can sue the third party without getting the assigner involved, right? They can claim their debt from the third party without getting the assigner involved. So they will have absolute right, no, they will have the specific right only, the right that the assigner had. The assigner has rights equal to that of the assignee, not more nor less. Okay. The assigner has specific interest over the property. The assignee will also have specific interest over the property. They cannot have absolute interest. All right. So the correct answer will not be D, it will be B. Equal to those of the assigner. Equal rights. Okay. All right. Regarding the pawnee's rights against third parties, which statements are true? So now we are talking about the contract of pledge. What are the rights of the pawnee? So what happens in the pledge? I pledge the movable goods as security against a loan. So the person who is creating the pledge is known as the pawner, and the person to whom interest the pledge has been created is known as the pawnee. So what are the rights of the pawnee? The pawnee has the same remedies against third persons as the owner would have. The pawnee cannot take action against third party. The pawnee's rights are limited to the original debt. The pawnee must involve the original owner to take action against the third party. So let's say any third party comes and tries to take away the pawned goods from the pawnee. They try to steal it, they try to deny the pawnee of the delivery. The pawnee, without getting the pawner involved, they can directly sue against the third party. No, the pawnee must not involve the original owner. They have the same remedies. The pawnee has the same remedies. All right, he may sue the pawner upon the debt or promise. He may retain the collateral goods. If the pawnee is deprived of his goods, they will have the same remedies against the third person. Right? So if a car has been kept as a pledge with me, some party they try, some thief they come and they take it away. They steal the car. I can sue, I can file a case against this thief in the court without involving the original owner, without involving the pawner. Okay, so they have the same rights in everything, in assignment, in any transfer, in pledge, in bailment, everywhere the person receiving the title will have the same rights as that of the owner. Remember this thing. Okay. According to the Companies Act 2013, what right does a fixed charge give to the creditor? So there are two types of charges, a fixed charge and a floating charge. Floating charge, which is a general charge, it floats over all the property of the debtor. Specific charge or fixed charge over some particular identified property. So when it is a fixed charge, what is the right given to the creditor? The right to transfer ownership of the property, the right to sell the specific property through a court of law or tribunal, the right to lease the property to a third party, and the right to use the property for personal purposes. Under this unit, section 4, the unit 14, certain powers provisions in the Companies Act are there, right? And the power given to the secured creditor, if it is a fixed charge, is that they can sell the specific property on the case of default through a court of law or tribunal. Okay, law or tribunal. Floating charge means when the company is wound up, it is liquidated, the floating charge will become a fixed charge and the bank will have the right over all of the property. Yes, absolutely correct. The correct answer is B. Which statements are true about the crystallization? Crystallization means when a floating charge gets converted into a fixed charge. What will happen? A floating charge can crystallize when a receiver is appointed. Crystallization happens only when the company continues. A floating charge may become fixed upon the occurrence of an event specified. Crystallization will give the floating charge priority over the subsequent equitable charges and the subsequent creditors. What will be the correct answer? First statement is correct, right? When a receiver is appointed. Second statement will not be correct. If the company continues to operate, floating charge will not become fixed. When the company dissolves, it is wound up, it is liquidated, then it will become a fixed charge. Floating charge can become fixed upon a event specified in the deed contract between the lender and the creditor. Crystallization will give a priority over any subsequent equitable charges and unsecured creditors. So the correct answer is D, 1, 3, and 4. That is why it is profitable for the banks to create a floating charge and get it converted if the company is about to liquidate or wind up. So they will have interest over all the general property. Okay. Next, which statements are true about the registration and notice of charge under the Companies Act? A registered charge gives notice to any person acquiring the property from the date of registration. Yes, it is deemed to be a public notice. Any subsequent registration prejudices the rights? No. Any subsequent registration will have rights after the one for which the charge has been registered. The registration of charge does not affect the priority. No. Once a charge is registered, this charge will get priority over all the other types of charges. If the charge is registered first, it will have priority over all the other later charges. Yes. So the correct answer is 1 and 4. Right? Very simple question. 1 and 4. Last question. According to section 78 of the Companies Act, who can apply for filing of the charge if the company does not register it within the specified period? So within 30 days of the creation of the charge, the execution of the charge, it has to be registered with CERSAI, right? If not, then additional fees up to 120 days is paid. Beyond 120 days, the charge cannot be registered. So the section 78 tells the creditor that if the company failed to get the charge registered, why did you not get yourself? Why did you not register it yourself? So it says that the bank, the charge holder, should get the charge registered if the company fails to get it registered. Any fees that is paid, additional fees that is paid, will be recovered from the company. All right, so the charge holder, the lender, the creditor, the bank will have the duty to get the charge registered within the stipulated time if our borrower fails to do that. All right, so these provisions of the Company Act, Section 77, the Section 80, Section 82, these are also important. That is all for today. There are topics more than these which are important. We'll be covering them in our marathon sessions. These are the mini marathons. That's why we have completed the most important ones, right? So that is all. Those who have not yet started your preparation, you have not joined the live classes, make sure that you join the super elite plan where you will get access to all the live classes, summary notes, numerical, everything, right? And we have also started with our revision. So the CAIIB all-in-one combo crash plus cracker batch, this is also live. So enroll now and start preparation because your exams are very close now. And that is all for today. Gopal, you did very good. You answered all the questions correctly. And I hope your preparation is going well, everyone who is present here. So, like this, we'll be covering other modules also on the YouTube channel. So, make sure you subscribe to the Oliveboard JIB CIB English medium channel. Your other papers are also being covered here. So, like the video, share the video, subscribe to the channel, and I will meet you in the next session. Tomorrow, we'll be having the mini marathon for our module C. All right, so stay tuned. Thank you so much. All the best and have a great day ahead.